Hi, this is John Tunison, CFO of Soluna Holdings, and today I'm going to answer some shareholder questions in what we call the Ask Me Anything or AMA series. Before I get started, let me remind you of a few details. The following content is completely qualified by the legal disclosures on the slide following this one. Our goal is to share with you some of our strategic thinking and financial analysis that we're using to guide the growth of the business. The content is in line with our principles of being accountable and transparent with our shareholders. Of course, we operate in a hyper-dynamic economic environment. That's really just a way of saying that things can and do change quickly. And what we're telling you here is based on our estimates and assumptions, which are our best guess. We reserve the right to revise our point of view based on new information and changes in the business environment. Despite an uncertain, dynamic environment, we must plan and make operating and investment decisions. This presentation lays some of that out for your review. So let me dive right in. Our first question is, what happened to the 12.5 million raised for Soluna Cloud? That's a good question. So the short answer is that 12.5 million note financing was provided by Green Cloud Partners, and it was used to make the down payment for the HPE agreement and to fund the startup working capital for Soluna Cloud. Even though we have terminated the HPE agreement, that note remains, and it is still being serviced by Soluna Holdings. Our next question is, how much does Soluna need to pay preferred shareholders before anything will flow to the remaining shareholders? Well, that's a good question. I think it refers to our Series A preferred shares. And those are indeed accumulating a dividend that would be payable upon a fundamental transaction or if declared by the board. There is also an associated typical liquidation preference. In steady state operations, there's no specific expected payment to any class of shares unless the board were to decide to pay the Series A preferred dividends instead of accumulating or deferring those dividends. The next question is, how much did Soluna spend on the servers, and was any of that recovered or recoverable? So I think this refers to our HPE GPU deal. And I think by asking about servers, I think we're being asked about that. So as we have discussed in our 10K filing, which you can find a link to in our presentation, we made the initial 10.4 million down payment and monthly payments from inception until we terminated the HPE agreement. We don't expect to recover any of those funds. Additionally, as required by accounting standards, we have recognized the remainder of the total contract value as a liability on the balance sheet at a subsidiary, Soluna AL Cloud Co. LLC, which is a subsidiary of Soluna Cloud Inc., which is a subsidiary of Soluna Holdings. Our next question is, how will Soluna stay listed as the closing price stays below $1? How much cash do we have, and how long will it last? How has it performed since the reverse split? How much do they have to pay for the preferred shares which have been in the backlog? So let me address the listing below $1 question. So as we have announced, we did receive a notification from NASDAQ due to our share price being below $1 for 30 consecutive trading days. And we now have a 180-day grace period, or until November 4th of this year, to regain compliance. If we're not in compliance by then, we may qualify for a second 180-day calendar period to regain compliance. And if we subsequently still don't qualify for or fail to regain compliance during the second compliance period, then NASDAQ could notify us of its determination to delist our common stock, at which point we would have an option to appeal the delisting determination to a NASDAQ hearings panel. The other questions, I think, have been addressed in our 10Q, where you can see how our balance sheet looks. We've made statements about our usable cash and how that's grown. I just answered a question very similar on the preferred shares. So I think I'll move to the next question. How many shares does the CEO, John Belizaire, own purchased through the open market and average share price? So as we disclose for our directors and officers and report to the SEC, our CEO, John Belizaire, owns just under 500,000 shares, 496,302 to be specific, of common stock, and 101,042 shares of Series A preferred stock. Management tends to be highly restricted in its stock sales and purchases because we're often in possession of material non-public information. We have relatively limited opportunities to buy or sell our stock. Next question says, great job on the simplification of the capital stack so far. Thank you. I believe a major factor in the depressed common stock price is the overhang of the Series A preferred. Have you considered a buyback of even a small portion of the Series A shares? This would be massively accretive and would help lower future dividend liabilities. Well, I appreciate that perspective, and we are constantly evaluating our best options for capitalization of the company, including specifically what you're asking about, with the goal being, of course, to maximize long-term shareholder value. At this point, given the exciting project development opportunities we have in our 2.6 gigawatt plus backlog and our ongoing development work to consistently grow the pipeline, we've opted to deploy excess capital towards these ends. Of course, that could change in the future as our capitalization grows. The next question is, it's quite exciting that you guys have a 2.6 gigawatt pipeline. Do you have any energization timelines for the 2.6 gigawatt pipeline? And are you able to disclose the general area where the sites are located? Great question. So first of all, let me just say that the 2.6 gigawatt long-term pipeline represents a very significant, and I would say our most strategic asset. You can look at our Q1 update slides to see the latest pipeline data where we list specifically the projects that make up the next several opportunities and are the ones that we've announced, and what the makeup of the remainder of the 2.6 gigawatts is. But here's a brief summary. 295 megawatts of term sheets, which includes Project Annie, our first solar project. 187 megawatt Project Rosa is in planning. 166 megawatt Project Kati is shovel ready. And Dorothy 2, which is nearing its first completion, is 48 megawatts and is in construction. So Dorothy 2 is expected to come online this year, soon. We hope to launch Project Kati second and third phases and complete those by the end of the year, as we've previously announced. And the remainder of the pipeline follows a standard utility scale project maturity curve. So it's been about 12 months, which is as to be expected with Dorothy 2. And within the next 12 months, we expect to see several projects underway and several reaching shovel readiness at or near the same time. So we can now begin to project our asset growth over several years, and we'll continue to do that. As to where sites are located, we've given some degree of specificity there, but many of our projects in the pipeline are located in Texas. Next question is, what is the servicing cost of the Green Cloud note and for how long? So as we announced in the Form 8K filing around the termination of the HPE deal and immediately prior to that, the restructuring of the Green Cloud note, we made certain modifications to it to ensure that the HPE agreement termination would not have a direct impact on the loan and the company's obligations. The company expects to continue to service the loan as part of those modifications. The debt service schedule of the Green Cloud note remains unchanged, and it's 5 years from the date of the loan, which was June of 2024. leaving us just over 4 years under the term of the loan, at which point it will be fully amortized. The next question is, how do you plan to develop all these projects? It would take years to get them all shovel ready, wouldn't it? Well, actually, a larger development phase pipeline and infrastructure usually points to a stronger platform. More shovel ready potential occurs each year, and that builds on itself. And that's what we're seeing at Soluna. One project that's moving through development could be delayed, but it means there are others coming online and reaching milestones alongside it at the same time. So the more projects and the more shovel-ready potential we have per year, the better. And that's how we view our pipeline and our acceleration. So for example, once we're able to break ground on Project Kadi, that'll mark the first time the company's had 2 projects under construction at the same time. And that is tangible evidence of us accelerating the rate at which we're developing our projects. So our final question is really a bunch of different questions that we received related to the company's general plan for financing and capital raising. So I'm going to address this by just talking about some facts, talk about our goals, comment on pacing of our projects, which I sort of went into in the last slide, but it came up in some other questions, and just give you some more detail about our project development and financing and capital raising. So bear with me, a bit longer answer than normal, but I think there's a lot of territory to cover and a lot of helpful information that I can provide to you, our shareholders. So here are some facts. Dorothy 2 ramp is absolutely on track, including the customer wins, despite some headwinds related to tariffs, which did slow things down a bit. Kadi capital formation is on plan. We have an ATM that we're using. We have a SEPA that we secured and can use. And we're also exploring additional equity financing options. So as far as we can tell, most of our peers have a similar, let's call it a tool belt of options that they use to finance their capital needs. By that, I mean an ATM, something like a standby equity purchase agreement, potentially S1 marketed deals from time to time, and project financing activities that are ongoing. So we're definitely falling in line with the rest of the market, and you should recognize that as what our strategy is. We have unfortunately been locked out of these mechanisms largely for the last 3 years due to a convertible note financing that we just recently exited in January or late 2024, early this year. So our goal is to use these capital raising tools to be able to raise the capital to own more of our projects. And this should be strongly accretive to our shareholders. And as you know, our capital formation isn't just limited to these TopCo tools. We're also looking at and able to work on more non-dilutive raises at the project level. And that can be both equity and debt. As you can see, for example, with the Galaxy loan that we closed earlier this year, which was non-dilutive. Let me address the pace at which our projects are going. And I talked about this in the previous slide a little bit, but the pace at which our projects mature is in line with utility scale behind the meter infrastructure projects. And it's really important to become familiar with that pace because it would be easy to assume that it's too slow. But actually, what we do and how we do it relative to many others doing something similar is actually very good and not, in our opinion, too slow. So I also talked about, for the first time, we've got multiple projects converting and developing at the same time. And soon we'll have more than one project under direct construction at the same time. So we have actual, real product market fit for our curtailment solutions. We have a strong brand in the clean energy space, and we've executed very well, as evidenced by continuing to grow our backlog and our pipeline and continuing to develop additional project opportunities with financing partners. So this is going to continue to increase shovel-ready throughput It's going to help accelerate that. It's going to open up even more capital formation and partnership opportunities. So we're not slowing down, we're accelerating and are excited about that. Now, one thing that one of the questions that came in highlighted was the value of our pipeline, and the implication was we should be monetizing that. And that is an absolutely true statement. Couldn't agree with you more. One of our core strengths and value drivers is our pipeline. And we are driving to develop those faster and, most importantly, to own more of them. Hence some of the capital formation activity recently and that might continue. So we've proven that we can develop the projects, we've proven that we can construct them, and that we can run them well, generating the strong and long-term cash flows. And then we can actually secure debt financing to refinance on those, which I think is another tangible example of the strength of the model. So after hurdle rate, with our current model that we have for our joint ventures, after essentially the JV partner hits a certain hurdle rate, we end up owning 50% of the cash flows of the projects, no matter how much we own at the beginning. So that is a huge driver of value for the company. So scale is definitely our friend, and that is definitely our goal. So I'll stop there. Once again, I will thank you for your questions. If for some reason we weren't able to get to your question, we will try to do that in a future installment. If you have questions and you haven't been able to ask them, please do so. You can do that online at X, formerly Twitter. Our handle is at Soluna Holdings. You can find us on LinkedIn. I encourage you to subscribe to our newsletter, and you can even find ways to communicate with us on our website. And we look forward to receiving your questions at any time. Until the next time, thank you very much.